Hi, welcome to the first lecture of 10K student investment valuation series. Today's lecture is focused on discounted cash flow basics. So uh, that's the very common technique used in investment valuation. I'm sure you must have come across investment valuation or discounted cash flow terminologies a lot in the past, and usually people present with a lot of you know complicated financial formulas and things like that. What I'm trying to do is I'm trying to really simplify and give you the essence of what exactly is this all about. So before even we delve into uh, like the details, uh, let us first see why even we want to do this. Why to go through this? It's kind of a lot of work. So usually people value like stocks because I'm sure common investors don't go and buy private businesses, so we invest in stocks. So you must have heard your friends talk about that. I just buy the stock, which is you know uh, selling at certain multiple or something like that. So I would like to show you something that I've put in my blog, which I really want everyone to think about. It's called the investment thought process. Again, there is no other person on earth more knowledgeable than Warren Buffett. We all know that. He's pretty much like, you know, you can say like God in the investment world. And and this is what he had to uh, tell about the thought process in his 1987 shareholders letter. So if you guys are not familiar, every year, um, as part of Berkshire Hathaway's annual report, he publishes a very nice letter which talks about the Berkshire Hathaway's business. And also, sometimes he gives away a lot of investment advice, not like you buy this stock or sell it, but more like the soft skills that are needed. So let's go through it. So here's what he's saying, and I'm just quoting him directly. Whenever Charlie and I buy common stocks for Berkshire's insurance companies, leaving aside arbitrage purchases discussed later, we approach the transaction as if we were buying into a private business. Just uh, just mind about the private business he's talking about. We look at the economic prospects of the business, the people in charge of running it, and the price we must pay. We do not have in mind any time or price for sale. Indeed, we are willing to hold a stock indefinitely so long as we expect the business to increase in intrinsic value at a satisfactory rate. When investing when investing, we view ourselves as business analysts, not as market analysts, not as macroeconomic analysts, and not even as security analysts. So here, the reason I'm trying to emphasize on this point is that he has laid down the process very simple. You have to always think as if you're going to buy the business. So if let's say you plan to buy a stock in Google, so you need to think that okay, I'm going to basically buy Google's business, and that's it. That's going to be the end. I'm not going to, there's not anyone who I can just go and unload it and then you know start thinking about it. And if you're new to this, this concept might sound a little strange, like Actually, you're not buying Google, obviously. So, why do you think? But as we go through our investment valuation, lectures, you will slowly understand the concept, and you will start sensing what exactly its value. So right now, just keep that in mind, and try to go through it. This is always going to be in the homepage of my blog. So again, if you have not gone to my blog, please do go to. Please, I um, recommend you to go. It's 10kstudent.com. So if you just go and type 10kstudent, it gets you to my blog. uh, so that was the first thing. Now, before we go ahead, I want to give you another very interesting aspect of valuation that I learned from a totally different person. It's nothing to do with Buffett. And I mean, I was amazed. To be honest, at the beginning, I was a little skeptical of this person, but later on, I really admire him. His name is Kevin O'Leary. People call him Mr. Wonderful, and he is one of the main characters in the TV show Shark Tank. So if you've not seen Shark Tank, I really, really advise you to please go, and because this it's been going on for a few years now, and they've got a lot of recorded shows also. The Shark Tank show gives you the real essence of how exactly a smart investor values the business. They're basically like small businesses go and pitch in for investment, valuing their business, and the sharks basically they are like top businessmen like Kevin O'Leary is there, Mark Cuban is there, Damon John, then Robert, and I forgot her name, Laurie or someone like she's from QVC, and so but here I really out of all I like Kevin O'Leary. I mean, you must be wondering, like, Shark Tank valuation, what's this going on? But if you go and watch the show, Kevin every time asks the first thing, how much cash is your business generating? He's not interested in the story. People come and talk big things, or what, I've founded this, I've got like 40 patents sitting, everything. And then when at the end of the day he asks how much cash he's in, oh, they say, we have pre-revenue. That means, they've not even gone and sold anything. And obviously, he doesn't even look at those businesses. I mean, it might sound quite logical to you, but the thing is, in Wall Street, sometimes things work in reverse because the people who actually make investment decisions, it's not their money, right? So the guys who are sitting, the big mutual fund managers, or the stockbrokers who are promoting things, it's not their money. So they get commission from you know businesses, this which obviously sometimes it's there are a lot of fine line they have to uh, walk, because they're advising, but they have to have arm's length. But if you look at a lot of deals that go on, I mean, it really doesn't make sense. The business sometimes gets valued for like $1 billion, and its revenue is not even like 10 million. So so this is the reason we need to understand investment valuation, because then we really know what exactly is the real worth of business, and why like, is it really pumped up by some broker, or is it really that much worth? So this was a little background. So now let us get to the main topic. Now, the DCF valuation, there are two main parts. The number one is management's ability to use all assets in order to generate free cash flow. Here we estimate the future cash flow and discount them to present value. And the second point is the net fair value of assets minus liabilities. And over here, we do not count the assets that are directly used to generate free cash. If we do it, it will be double counting. Now, obviously, I'll explain you the concept later. So right now, just understand there are 2 points. One is management's ability to generate, a free cash, and the net fair value of the current tangible assets the business has. So let's take an example. Let's assume that Sunny Trucking Company, it's a small trucking company, has about 50 trucks, and they're valued at $3 million. And you know, now I'm introducing you to little basic accounting. Like a balance sheet has assets and liabilities. So I'll cover details of a balance sheet, income statement, cash flow in a different lecture. But right now, just like a basic, so assets is basically what they own, they owe, and the liabilities is what they own to others. So in the assets, I'm looking at the cash. They have $2 million and the value of the trucking fleet. So these are the two big assets they have. It's about, if you add, it's $5 million. And liabilities, they've borrowed little money short term. They're going to return it like in a month or so. They got accounts payable. Which basically means like they have to pay like salary, which is pending, like which they should have paid, but maybe they're running late a little bit or something like that. And to the vendors, things like that. And they've got a little long-term debt. That means they've taken borrowed money for more than a year, and it's about $500,000. So the total liability, so 0.2 million plus 0.3 million plus 0.5 million, is about $1 million. Now the business generates $1 million free cash every year. So now again, I've put another term here called free cash. So what exactly is free cash, you might be asking. So the free cash is the net cash generated by the business minus capital expenditures. So first let us tackle the net cash. Right now, in a very simplistic way, you can say that net cash is the total cash the business gets the whole year. That means, their sales, right? Every time the trucking company goes on a trip, their customer pays them. And all the expenses. So the trucking company has to pay to their truckers, their fuel, their office, their legal, accountant, and different government fees. So all the fees, everything that they pay. So whatever they get and they pay is if you do that minus A minus B, then you get net cash generated by the business, and then the capital expenditure. So here, this is a concept where, the total money they have to put in to upgrade their equipment. So that if you've seen any small business, even of any size, they have to, excuse me, keep upgrading their equipment. So over here, the biggest equipment is uh, the trucks. So they have to get maybe repair some trucks, get some new ones, things like that. So all the money that they spend there, if you deduct that also, so after all doing all that, they are left with $1 million every year. Now the reason it's called free is because the owner of the business can do anything they want out of it. They can either reinvest that business, the money in the business, to grow it or do something or pay a dividend. So that's why it's called free. They're free to do whatever they want, and so that's how they generate $1 million. Now, let us assume that the company is specializing in transporting hazardous chemicals. It's a niche business, and the company has built an expertise around it. So thus it's able to generate healthy cash flow because it's not many people know about it. So they obviously have very good safety record, and they have built processes by which they know how to transport it. So that's their core competence. So because of that, we can assume that for the next 25 years they'll be in the business and they're stable. So usually when you value the real businesses, there is another factor that you'll be focusing, that's called growth. So right now I'm not, I'm keeping it very simple. So usually, you'll never see a business that has a constant cash flow for 25 years. But here I'm keeping it very simple because I want to explain you the concept. So we're just assuming that, the owner is happy every year he gets 1 million, he just keeps in his pocket. The next year he gets, so, that's the business. And we know that, based on their current skills and the current way the customers are, the next 25 years there is a high probability that they will be there. Now, if we assume a discount rate of 5%, the sum of the discounted cash flow for 25 years is 14.45. So now you might ask, what's discount rate? So, sorry, how does this happen? So, um, let's open an Excel sheet. I'll try to show you. So, let us put year here, free cash flow. Okay. Now, over here we are putting discount rate. Okay. So, I told we are having 25 years, right? So let's this add one, I get this, and let's drag it and okay, 23. It's 25 years, and now the free cash flow every year is 1 million, right? So we'll just take this and let's freeze the pane. So this is called I'm making like a discount table. So it's pretty easy. So you created the number of years, this thing, then the discount rate is 5%, right? So what we do is 1 minus 0.05 is 0.95. So we just put 0.95. So that means if you discount something with 5%, it's as good as multiplying by 0.95. Now the second year what's going to happen is this again you multiply by 0.95. Just format it so that so now you'll see. Now if I drag it, see this keeps reducing. So as you keep discounting, the discount factor, so let's call it discount factor actually. And then let's call this discounted cash flow. So this is going to be this multiplied by this. So if you just drag this, you get all this discounted cash flow. So obviously let's format this also. Let's make it a currency. Now let us add this. That means year 1 to 25, if you add all the discounted cash flow, so you're getting around 13.73. It's yeah, but that's the total figure. you're getting. Okay, now actually 1 minute I think. Okay, sorry, it was my mistake. So the first year obviously uh, uh, you're counting the whole $1 million because you're just getting it right away. And at the beginning of second year, that 1 million is actually 0.95 because it's you multiplied by 0.95. You discount it by 5%, and this becomes that. So if you keep adding that, it becomes $14.45 million. Okay, so that's what we are talking about here. Is that the whole the discounted cash flow for 25 years is $14.45 million. Now, obviously, we have not yet gone through like how we got this discount rate, what exactly it is. So we'll go through later on. So now let's complete this exercise. So the value of the business is A plus B. So A we found out 14.45. Now B is $1 million. So what is this 1 million? This is again the net book value if you and you do not include the assets that you use for cash flow. So the net book value is 4 million, and from that you took out 3 million, that is trucking fleet, you got 1 million. So you add that, so you get 15.45 million. So yeah, I mean pretty straightforward, right? So you just valued Sunny Trucking Company for $15.45 million. Okay, that's good. So now there is another concept I would like to explain, is called FCF multiple. Now why that's important is because many places in my blog, wherever you see valuations, you'll see this terminology. So this multiple is nothing but what we finally get by putting the discount rate and then final value divided by the cash flow of the first year. So that we got 14.45 was, you know, the free cash flow, and then if you divide by the cash flow from the first year one, it's around 14.45. So I just rounded off to 14.5. So this is just to explain you what is FCF multiple, because you will be seeing this a lot in my blog. So if you go and, you know, just for the heck of it, so this is basically my watch list right now. I'm following about 194 stocks. So here, let's just take Apple for the heck of it. Everyone follows that. So here, this is the quick valuation I do. Okay, so this is after all the analysis I've done. I just put in my final value. Is that base FCF? That means the first year's free cash flow that I'm projecting is 45 billion, and the multiple, I'm assuming it's 12 based on my analysis of the growth and the risk. So 45 into 12, and plus the net book value for valuation. That means the current cash. So Apple has tremendous cash sitting in their balance sheet, and also this is one of the highest. Apple and Microsoft are the highest. So if you do 45 into 12 plus 90, you get $630 billion. And obviously they've got $6 billion, 6 billion shares outstanding. So if you divide 630 by 6050 million, you get about $104. So that's my valuation for Apple. So again, this is just to show you why that FCF multiple was important. So this is where that concept came in. So let's jump back to our topic. So here uh, now we covered that. Now coming back to our point where you know uh, I mentioned that the free cash, we do not count the value of the asset that generates it. We think it's double counting. So just think about it. As uh, you might put an argument why we do like that. Why not just put that 3 million also. So if you buy this business, the Sunny Trucking Company, you need the trucks to generate cash, right? Now, if you count the truck, and that means you can just sell the truck tomorrow and get the 3 million, yeah, you can do that certainly. But then you will not be able to generate any cash because you won't have the asset to generate the cash. So you can either sell the trucks and get 3 million and don't do anything, or keep the truck to generate the cash. The moment you deploy something to generate the cash, that cash that comes out of it is its value, right? So this is a very important point one should know, because so many times what happens is people double count, and they really messes up their valuation. So just keep that in mind. Any asset that you use it for the business to generating cash, and then that means the value of that asset is already being counted. Now here one also needs to be really careful to understand that there are a lot of hidden assets which are never talked about much, and they'll be hidden somewhere in the 10K report, in the footnotes and all. Again, I'll be explaining you all those things detailedly in the next lectures. And that actually can unlock the value. What we call is called unlocking. So let me give you an example. So let us assume that the trucking business also owned a piece of land that it once had bought with the intention of making a garage. And the land is sitting idle and is not used for the company's business. And if we assume that the fair value of land is 0.2 million, okay, so that means they had bought the land, let's say some 5 years back, to build a garage, never materialized, it's just sitting there. So the land has zero contribution in company's current business, right? The business is to give the trucking service, so land is just sitting idle. So that land's fair value can obviously be added to the business, because the owner can just sell off the land next day and get whatever its free value and deploy that cash in the business, or just pay himself a dividend. So that is very important. So if that was there, then this about 0.2 million would have been added. So this is a very important concept I was trying to say. Uh, Now here I'll give you another very interesting point, and you will just be amazed when you understand this. Uh, Let us assume that there is another trucking company called Blue Light Trucking. It's pretty much does the same thing. It also transports hazardous materials, has the same cost structure, generates the same amount of free cash. But the only thing is, Blue Light has $1 million of long-term debt as compared to 0.5 million for Sunny. That means the long-term debt means it has borrowed about 500,000 more than Sunny. Now look at the fun. If Blue Light and Sunny were trading in Wall Street, our so-called very knowledgeable analysts would obviously rate the both stocks same. They'll be like, oh wow, yeah, Blue Light, Sunny, well, they got same earnings, same growth. Let's both give them like a multiple of like 10 or something, and boom, their stock prices are same, value is same. But what is the real story? The real story is that Blue Light is not worth the same as Sunny because blue light owes 500,000 more than Sunny. To put it in a very simple word, let's say instead of Sunny you bought blue light. Now obviously the day you buy the business, you also own the assets, but you also are responsible for the liabilities, correct? So the day if you buy Sunny, you are responsible for $500,000 of long-term debt. That means, there's a bank or someone sitting there who would want you to pay 500,000 out of all the cash you generate. Now in terms of blue light, it's not 500,000, it's 1 million. So out of the whole, once you buy and you keep the business for 25 years, obviously for blue light you'll get less money, right? Because you'll be paying off 500,000 more. So in reality, blue light is less valued because its balance sheet, the net tangible value, is less than that of Sunny, even though their operating cash flow and free cash flow are same, but their book values, tangible value is different. So this is a very, very, very important point because this is going to be your edge on other investors if you follow. I hope so. You will be, a value investing principle. Because the problem, what happens is the the market and all the people, they always focus on earnings. They always see, oh, okay, the earnings have jumped, the earnings have done. Very few people actually talk about balance sheet, and that is where a lot of hidden things are there. And sometimes it's not even balance sheet, it's off balance sheet items. They will be somewhere mentioned in the footnote. So obviously I'll be teaching you all that, how to identify, and this is where you can identify the hidden value of any business. I mean, one of the places. There are many others also. So we've pretty much covered all the items. So we saw how to value the business and different components. We saw uh, why we do not count the value of the assets that produce cash in the tangible and the importance. Now the final thing, which is the cornerstone, which can you know really take your valuation here to there, and technically speaking everything can be right here or everything can be wrong. It's called discount rate. Okay, now obviously you must be asking like why to use it and how to get it. So discount rate is the sum of risk-free rate and the risk premium. So if the business is more risky, then the risk premium is higher. Okay, so let us assume that you have an offer to invest $1,000 in a business. So over here you have an option to either put in the business, or you can also put in a risk-free investment. So risk-free means literally nothing can happen. So like a treasury bill, okay, uh, that's considered risk-free. And so if you put there, you be guaranteed literally whatever interest rate they pay, and so that's the percentage you get. So if you don't do that, so obviously you're foregoing it, right? So that's basically like a lost opportunity cost. So that is one thing you will need to consider. Now the second is the risk you're taking by investing in the business. That means you're assuming today that the Sunny Trucking Company will be doing certain things, but who knows, after 5 years things might change. So as time goes by, the probability of you getting what you assumed is going to be less, so you want to discount it. So that's called the risk premium. And so the concept can be also explained in a simple way that let's say I give you an option. You either take $1,000 now, or you take $50,000 after 50 years. So you have two options, okay? I'm standing with two checks in my hand. Either take $1,000 that has today's date, or take $50,000 that has a date of 50 years in future. So what will you do? I'm sure at least me, you'll just take $1,000 and forget about it, because who has seen what's going to happen in 50 years? It's a lot of time, right? I mean, I don't even think, I'm 41 now, like I'm not sure even if I'll be alive. So 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 it makes more sense. So even though it is 50 times more amount, still you don't think it's it's worth the risk. But in Wall Street, you'll be amazed if you do the uh, comparison. Many times people just go for the second one. Oh wow, it's going to be a lot of money, or whatever time it takes. I'm fine, but it's a lot of money in future. It's going to make tons, even though now nothing. So they give up the option of owning $1,000 now, and they go and take up the option for $50,000. So 50 is obviously more than one. They don't see when. So this is why we need to keep this point really in mind, like that this impacts. So now, if you see, the 2.5% was the opportunity cost, and the 2.5% was the risk free. So now you might ask how that 2.5% risk premium I calculate. So this is just an example, but this is where your judgment will come. Like, how much you're judging. So usually, you know, it goes from like about 6 to 12%. There are a lot of different parameters, people, but you just need to be a little conservative, and just make sure you've got enough factor of safety. So you add 2.5 and 2.5, so that becomes 5%. So 5% is the discount rate. That's how it gets calculated. Now, another one very last point that I want to cover, which I mean, you might not find in a lot of textbooks or anything, but this is purely based on my practical experience. Okay, so I'm originally from India, so I visit there once in a while. Go meet my parents and other friends and all. So, uh, you know, so my point is that, let's say if someone in India wants to invest, okay, and I'm just thrown out for some figures here. It's like rupees 10 lakhs. So in India everything is like lakhs and crores. So a lakh is nothing but like 100,000. Okay, so 10 lakh is like a million. So 62 rupees is $1. So if you convert it, so it comes to around uh, like 16,129 dollars. That's about a million rupees. And if someone is trying to invest, what he or she will be doing. So if you again go back and do the same exercise, his first option will be like, what's the safest bet he can do? Now in India, the interest rates are high. So the safest bet for him actually would be to simply go and open a 1-year fixed deposit account with State Bank of India. That's the most reliable and the most stable, and it's like partly nationalized and everything. It's like really safe bank in India. Even I have the account there, and I mean, even though they're not that techno savvy, but believe me, uh, no one in my family has ever lost money by putting there. So I really trust them. So just think about here. The guy goes and spends 10 minutes filling some form. Boom, he gets 9%. Doing nothing. No risk, nothing. Now think about it. Will this guy be interested in investing in stock market if the stock market gives, let's say, around even 10%? No, right? Why will he take the risk? Because he's already getting 9%. Now the only way he should be interested, if there is a possibility to generate, let's say, about 20%, then it makes sense, because the the opportunity cost, even if he loses, he's getting, a good, uh, like a difference. 20 minus 9 is like 11% extra he's getting. Whereas in US, it's not the same. Its risk-free rate is 2.5. So even if you get like a 8% return in the market, people jump around. Wow, it's good, because you know 8 minus 2.5 is 5.5. So you got that extra. So this is why I feel like, the risk-free rate, if if you're following my lecture and you're not living in US and you're living in India, so you have to adjust that accordingly, because it's totally dependent on your choices available right now. Okay, so if you're living in India and you put your risk-free rate for 2.5%, let's imagine, then even a stock investment giving you a net 6% return would seem good. And but it will be stupid, right? Because already you're getting 9% in the fixed deposit. Why will you put a in a stock expecting 6% return? So that's the point. So I hope you liked, and you gained some knowledge. So please go through the blog post, discounted cash flow basics. And also I would really be happy if you just tweet me, follow at 10K student. I'll be happy to answer any of your questions. And thank you, and I hope you come back again. Thanks.